Today's interview is with John Casmon. John's a really cool guy who has an awesome voice. So if nothing else, just stick around and listen to his voice. But more than that, John is a very successful multifamily real estate investor. He talks about why he likes multifamily, how he got started, and all that good stuff. He also has a phenomenal podcast called Target Market Insights. So check that out as well. As always, like and subscribe on the YouTube channel Wrestling with Real Estate. Go to the WWRE Podcast and give me a 5-star rating and write me a review if you think it's worthy, and of course it is. And I'm looking to speak to as many of you as possible. If you're interested in real estate and you love to talk about real estate, you can go to the link in the description down below and schedule a 30-minute call, or you can go to wrestlingwithrealestate.com and schedule the call there. I'd love to get to know you, hear more about you, find out if there's any way whatsoever I can help you. But before that, stick around for today's great interview with John Casmon.
Hello and welcome to Wrestling with Real Estate, where we look to chokeslam all your real estate problems. I'm your host, former WWE wrestler, and now Cirque du Soleil performer, and of course, multifamily real estate investor, Barri Griffiths. Now today we have John Casmon with us. Hey John, how are you doing?
Barry, I am great. Thank you for having me on, man. I am pumped up for this one. So it's going to be a fun episode. I look forward to talking to you.
Yeah, me too. I'm really excited to get into a conversation today. So I appreciate you taking the time and being here. Super busy guy, super successful guy. So I appreciate you being on the show. Before we get into it and kind of dive into the conversation, you want to tell us a little bit about your background and kind of what you focus on right now?
Yeah, absolutely. So before getting into real estate, I was a full-time marketing executive. So worked on a lot of marketing campaigns for brands like Nike and Coors Light and Mountain Dew and other brands like that. And on the side, I was building my own personal real estate portfolio, small multifamilies, started with a 2-unit, then a 3-unit building, finally made the jump to an 8-unit commercial building before really going larger into apartment syndication with some larger properties. So now I'm a full-time real estate investor. I also work with other investors looking to I was trying to say scale and grow, so I said scroll. That's not a word. So
maybe it should be a word, maybe, right?
Scroll is completely different, right? You know what scroll is, but looking to scale their real estate portfolio. So that's kind of what I'm doing right now.
Cool. So you started in branding. That's
right.
Wow. Okay. Well, that's kind of a cool job to kind of use skill set to use for real estate investing, right? Is that something that you'd be able to transition over into real estate investing?
It is, and it's one of those things where at first it may not feel like the natural transition, because marketing, I mean, that's pretty much fun storytelling, advertising, colors, campaign logos, and real estate is like brick and mortar contracts and numbers and numbers and numbers and numbers, right? And so I think initially you wouldn't see how it really correlates, but the reality is marketing at a whole is really just how you drive business and how you communicate your business, your services, your attributes to potential customers. And that correlates across any kind of business enterprise. So when you really break down what real estate investing is, particularly what we're doing when it comes to working with other investors, all we're really trying to do is convey the benefits of working with us, what the upside potentials are, and making sure that we build our name, we build our brand, we're getting ourselves out there so people know who we are, what we do, and how we can help them. So branding absolutely plays a big role and was really critical for me to make that transition.
Yeah, and I think what you touched on there, which is always important, I think, for people to understand, is that it's a business, right? It's like you said, it's brick and mortar, it's tenants, it's rent, it's repairs and maintenance, renovation, but it's a business, and business and marketing is always, critically important for a business, right? Because if you have the best business in the world, doesn't matter what it is, and nobody's ever heard of it, well, it doesn't matter. It's like like YouTube, right? I always talk to people about YouTube, like, oh, I'll start my own YouTube channel. I've got some really good content, or I think people would laugh at my jokes, or I'm going to work out and people would really see me. Well, yeah, but if you just put it on YouTube and nobody ever sees it or hears from it, it never happened. But you've got to market and brand that and build it and, create that marketing with that. So it's exactly the same in real estate. If you have, if you're creating a business for yourself and you're aiming to grow and bring on investors and find deals and meet all these people, if you're just doing it in a vacuum, almost nobody ever will have heard of you. So I think it's critically important that people understand that how important marketing is, and you as a person is, or you and your partners, whoever is running the business, is also very important, because that's what everyone's going to look at, right? They're going to look at, yes, the company name and everything, but they're the ones that you're the ones that they're going to deal with. So I think that's a great point that you brought up, that you don't always associate both with each other, but they're really, really a good fit with each other. So you said that you started, what made you start investing in real estate while you were doing this, working in the branding business?
Yeah, great question, man. So for me, what really happened was I was always trying to figure out my pathway. I joked with you before, but in my head, I actually thought I was going to be like you, Barry, and be a big time professional wrestler. And any of you who know me or have met me know that I don't have the same physique that Barry has. So that didn't really pan out. But the other thing was, as I was doing research and learning about, different careers, I wanted to be a radio host at one point as well. That also didn't work out. But one thing that did jump out to me was real estate. And I loved marketing because I enjoyed really understanding the psychology behind it and the storytelling and just how brands, just like everything that went into it, right? I mean, that's big business. You can do marketing for big brands. You can do it for individuals and entrepreneurs. And I really enjoyed that piece to it. But on the same side, I looked at how other people were building wealth. And real estate was one of those things that kept coming up, and in particular, apartment buildings, buying apartment buildings. So when I was a young executive at General Motors, it's 2007 when I joined the company. 2008, we started to hit some financial issues. You all know what's happening with the financial crisis. And I was there trying to figure out my life. I was a young executive. Company is going through some rough times. The country is going through some rough times. And at that moment, I realized that I didn't want to be in a position where I only had this one source of income to take care of myself. And I was single, so it wasn't that big of a deal. But on the same note, I went to college, first for my family to go to college and graduate. I spent a lot of time and energy just building my name, building my personal brand, if you will. And I was trying to apply for other jobs. I was trying to get a job at other companies. And they were like, no, you only have automotive experience. We don't really want to hire somebody who only has that. And I just felt like I didn't have any control of what was going to happen. So I had to ride it out and then pivot. So I did. I stuck with General Motors. We wrote it out. And I remember they were doing layoffs and they told me not to worry about it. And I was fine. And the next day I went into the office. There's a voicemail on my phone, red lights blinking. It takes me about 20 or 30 seconds because my heart just starts pounding. I'm like, dude, they're going to let me go. And it was actually from a colleague. And he was like going, fortunately, but he just left a message and talked about how he had dedicated his career to this company to let him go. And at that moment, I think it just really crystallized that I was going to keep working the job, but I was no longer going to be vested only to this company. I was going to build something for myself. And I'm not a tech wizard. I didn't know what else to build, but I knew real estate was something that was abundant and something that I could start learning even more about. So I started reading more books on real estate and just educating myself. And it took me about 2 to 3 years before I bought my first property. But once I bought that first property, I think I was hooked. It cemented it. It made it real to me. I started meeting more and more real investors as opposed to just, these fantasies and the books and podcasts that I was coming across. And I think that really made it tangible and practical. And honestly, once I realized that power and the impact it could have, it just took off and I became obsessed with it.
That's cool. That's cool. And I like how you talk about how at one point, right? And I think a lot of people go with this. You think the W-2 is the way to go, and that's how you're always going to be. And you just think that your boss is always going to provide for you, or your company is always going to provide for you, right? But something that I've talked to a lot of people about, and it sounds maybe a little repetitive for people that keep listening, but I think it's so important, is that people say there's risk in real estate, right? But I think there's even more risk not investing in real estate. It's even more, or whatever you want to invest in something, right? Not having that other focus. Because if you're just relying on your W-2 job, right, as you mentioned, right, you had that blinking light and you thought, oh, this is the point where I'm going to let go. And where do you go from there, right? I had that point in my own life. And that's kind of the realization that I had, that if you, it's risky to just depend on one company to provide you, and now we both have families livelihood. It's their livelihood, right? It's the roof above your head. It's the food. It's the clothes. It's everything, right? And if I think it's way more risky to just rely on one company or one boss or one whatever source of income to do that. Because with real estate, the amazing thing is you can create multiple streams of income, right? Yes, real estate is the vehicle, but it's very rare that you just have one property, right, that you're just, and you can have that, and that could be good as well because you're kind of in control. But it's that multiple streams of income that, to me, it's way less risky to invest in real estate than to not, in my opinion.
Yeah, and I'll take it a step further, because I think you're 100% right. But for me, when I think about it, you have to look at the adjusted risk as well. And the thing about real estate, and you can invest in whatever you're comfortable with, but the thing about real estate, especially houses and apartments, there's a physical, tangible value there. So let's just go worst case scenario, okay? Let's say you bought it wrong, you managed it wrong, whatever. There is still value in the building, in the land itself. The raw land still has value. And most of the times you're buying it because you expect other people to want to live there. So there's going to be demand for that location, So there's value there. So your downside, your absolute worst case scenario downside, is mitigated. Some of you've got insurance and some of this other stuff, right? But your downside is mitigated. Okay. And then if you're going to buy an existing property, a cash flowing asset, which is something we always push, buy something that's making money day one. It's different than flipping a property. I'm not talking about buying something that's vacant and then trying to flip it. You probably want to have a little bit more experience and have a team if you're going to go that route. But if you're buying a cash flowing real estate property, and it's making money and there's some demand there, it's kind of hard to mess that up. There's some things that could go wrong. You may not hit the returns you really want. I'm not saying that, but I mean to the point where you lose money on a cash flowing asset. That can be a challenge, right? So, and things happen, circumstances certainly happen, but I think you can always go into it with a very conservative game plan, especially starting out, especially if you think that it is risky. You can buy something that's fully occupied, cash flowing, buy it based off of what it's doing today. Do not plan on, making big improvements. Just take care of stuff that needs to be fixed. And you would have an asset that's going to take care of itself as long as you continue to reinvest in it. So and I'm oversimplifying, but it's something that I think has mitigated risk versus just launching a new company or launching a new business that could absolutely go down to a value of zero, and all the dollars you've put in, are for naught. I think that there's some intrinsic value there. And, for me, my father worked 2 jobs in his life. Technically, he worked a third one too, but that was while he was on strike at one of them, right? So his whole thing to me was get a good job, you work it until they kick you out, or you retire. And that's what I was fighting with internally. Was I was raised to get a good job, keep it, work it forever. And here I was working at one of the largest companies in the world at headquarters, by the way. It's not like I was working in the parts department or in a warehouse or, an assembly line. I was working in the ivory towers, making these, I was doing marketing stuff and fun stuff. Big budgets and celebrity things and video game integrations. I was working on fun stuff for a young 20-something year old, right? But to have the foresight to say it's still a job, no matter what. You're being paid a salary to do a job, and at any moment they can take that away from you. And that was the fear for me. The fear was they would, and it doesn't matter how great you are at your job. At some point, you are no longer the man, and they will take it away from you for whatever reason. And if you've built your entire identity around this and your entire, finances around this job, you really leave yourself exposed. And I just felt for me personally, and I think for many people, you owe it to yourself to at least build some other streams of income, even if you love what you do. I mean, I worked for another 9 years after I started investing in real estate, because I still enjoyed marketing and advertising. I enjoyed it. So I did it for another 9 years until it got to the point where it was no longer feasible for me to do both. And that's what I would say. If you love what you do, great, build it. Or you can be passive, join someone else and invest in their deals. But you need to figure out how you have multiple streams of income. So if the worst case scenario happens, you're not scrambling trying to figure out how you're going to take care of your family.
Yeah, that's great. I love that. I love that because that's one of the many great things about real estate is that you can design your life around the real estate, right? So you can be passive and pretty much not do anything. That's all, wait for that check to come in, use other people's strengths and work with them and have them do all the work for you. Or you can be as active as you want, right? Work, 18, 20 hours a day and, do that as well. So it just has that flexibility to be whatever you want it to be. So I think that's such a great point. Now, so you decided, you had that moment where the blinking light came on and you're like, oh no, is this my time or whatever? It's funny that you remember that so vividly, because I think a lot of people have that moment where they realize, I need to do something else, or I need another form of income or whatever. I know I did, and a lot of people I speak to as well. So from there, where did you go from there? You said you did some networking, you read some books. What was your first investment?
Yeah, so I mean, professionally, the good thing is I kept my job, so I continued to grow and thrive there. But I was still in Detroit, and if you guys remember Detroit at this time frame, I mean, if you wanted some negativity and if you wanted to pin one city for the economic downturn, I mean, people would put Detroit up there. So every time I turned on the news, all you would see is, oh, this is a Detroit issue. And it actually, I didn't realize this was a whole U.S. economy issue until like we got closer to the election season, because up until that point, up until like Lehman Brothers and the big financial institutions collapsed, it was an automotive issue. So it was just the big three. It was just, American cars. That was the issue. So for me, part of it was I realized I wanted to get out of Detroit. I wanted to go to Chicago in particular. And I was looking for opportunities there. So when I moved to Chicago, I really started to look for investment opportunities. So I bought a 2-unit building in a neighborhood called North Center, which was a great neighborhood. And I'll tell you, for your first property, you just have a lot of questions, right? You don't know, is it the right location? Is it the right property? So I did a lot of research, did a bunch of marketing research on finding the best neighborhood in Chicago. And one stat jumped out to me like a huge neon sign, okay? So I'm looking through things like Chicago Magazine. It has 77 distinct Chicago neighborhoods. Only one did not lose any value. The houses in those neighborhoods didn't lose any value during the economic downturn. North Center. I saw that. I just flung the rest of the paper over my shoulder and said, North Center, that's where we're going to look. So that's our criteria. Look in North Center. We're going to find a 2 to 4 unit there. And we found one there. And it was great. I mean, it worked out extremely well for us. And for me, it was like, listen, if you didn't lose any value during the downturn, then I don't care why, right? The reality is it's got to be super stable. There's something there that's making it ridiculously stable. And that's good enough for me. If we're trying to mitigate our downside, that's good enough for me. So I found that stat, and that made it really easy to pick that neighborhood. Now, I wish it was that easy going forward. It wasn't. So I had to really figure out more of my criteria and things like that as we went forward. But that first deal made it really easy because of that one stat.
Yeah. And I think I don't know how you realize that, but for a lot of people, myself included, when I started looking for my first investment property, I wanted to hear, I'm here in Vegas, and that's where my first investment property was. I wanted to look all over Vegas because in my head, I want to see all the deals. So the more deals I see in my head, and I know it was completely wrong now, but in my head, and I think a lot of people make this mistake, if the more areas you're in, the more likely you to find a deal. But I think that's actually counterintuitive, because if you can narrow down on one area, you can learn that area. You know what rents is, you know what price per square foot should be, you know the good streets, you know the bad streets, you know everything about that area. So when a deal pops up, you can pounce on it. You know if it's a good deal or not. Where if you're trying to learn the whole city, as I found out, it's impossible to do that, because you can't know street by street. You can't know what rent is in every single area of town and submarket and everything like that. So I think that's great that you were able to do that. What were the numbers on the first deal? How did you figure out if it was a good deal or not? Apart from the area, of course, you'd figured out that was a good area.
Yeah, so a couple things we did. First and foremost, we were looking to live in the unit as well. So we're going to live in one unit, rent out the others. A lot of folks call that house hacking. So we were going to house hack, and for us, it started with picking a place we'd want to live in. Find a place you actually like, you'd want to live in yourself, and make sure that the numbers work pretty well as an investment. So I knew North Center was a great neighborhood. The household income was high, had a great school district. There was a Trader Joe's across, literally down the street. There was a Brown train stop, a couple blocks away, which for Chicago, the train was one of the big drivers. How close are you to the train? So if you can get close to a train stop, it's going to be very appealing to most people, because the train will take you, into the city, way more desirable than just being next to a bus stop. So it had all of those things, which were on our checklist of places we wanted to live at. So my cheat sheet for anyone who's looking to do this is treat yourself like a renter. Okay. Look at it from the renter's eyes, not your investor eyes first. Look at it as a renter's eyes. Why would a renter want to live here? Well, it's close to the train. It's close to, grocery store. It's close to these amenities, the park, whatever, the school district. So you have to put yourself in the renter shoes. And luckily for us, because we were living in it, we had our checklist before we got to the business, the investment checklist, right? So we went through that, and that got us a tight kind of, narrow neighborhood, even within North Center, that got us kind of a street by street kind of block of where we wanted to go. And basically, we just followed the train. And we said, hey, we want to be, a 10-minute walk outside of the train station. If it's more than that, it's going to be too far. So that started off. On the numbers itself, we actually made a list, because at this time, the market was still soft. So we made a list of all the properties that we felt fit our criteria. We had a top 10 list, and properties started coming off that top 10 list. We had about 2 or 3 weeks, and then about week number 3, properties 3 and number 7 are off our top 10 list. We added 2 more. 3 properties came off the list. 2 more properties came. We're like, oh, we need to move. We can't just sit and wait. These are coming off the list. So we went back to the ones that were originally on our list. We went and looked at them again, and we ran some quick numbers. There was a 2-unit building. We acquired it for $362K. And the thing that jumped out to me on this particular building is the top floor was a 3-bedroom. The first floor was a 2-bedroom, but the first floor, the 2-bedroom was actually renting for more than the 3-bedroom. So by $200, I mean, by a significant amount of money, it was like $1,400 to $1,200. And I mean, you don't have to be a rocket scientist to know that the 3-bedroom should probably rent for more than a 2-bedroom. So we knew that there was clearly some value add potential in this property. We decided to renovate that top unit, live in that unit. The first floor rent unit was actually below market rent as well. So we pushed rents a little bit there, made some upgrades to it. And then ultimately the top unit we did, but when we were done, I mean, the value was probably $700 more in rent than when we initially bought the property. So we really were able to push it based on that, based on what we saw.
That's cool. Yeah, that's sounds like a good first deal, right? It kind of went pretty well. How long were you guys in that one for? You guys live in it for a year and then move on, or did you live?
No, we stayed in there the whole time we were in Chicago. So I moved out last year, and this is we're just selling it right now. So it's been with us 8-9 years, something like
Oh,
that, 8 or 9 years.
wow.
So
Okay.
yeah.
It's been a good deal, and yeah, because that first deal is usually, the scary one for most people, right? Once you get into that first deal and it kind of, you kind of works out, as long as you don't lose money per se. For a lot of times, I think it's that proof of concept that you can go on and do other ones. I don't know if it was the same for you, but I think I hear
Yeah.
it time and time again that you do one and then you realize, okay, this isn't so bad. The roof didn't fall in, the place didn't continuously combust, everything worked out. The renters didn't, break everything into place. So then you feel like you can do more. So from there, how many of the single families or residential for 4 units or less did you guys do until you went to something bigger?
Yeah, just one more deal. So the next deal we did was actually a 3 unit, and that was in a different neighborhood. And the challenge on that one is, in the first deal I mentioned the big blinking neon signs that told me this was the neighborhood to invest. I didn't have that for the second deal. There was no stat that jumped out that made it crystal clear. So I did a lot of research and try to figure out where I wanted to go. I knew Logan Square was a very popular neighborhood. It was trendy. It was the area I wanted to go into, but the numbers just didn't work. I crushed them multiple times, and I just couldn't find a deal that made sense or pencil. There was an adjacent neighborhood, though. And here's another tip for your audience. When you're looking for great places to invest, you know, find the hot areas, find the hot neighborhoods, the trendy areas, the places where the millennials want to go, and don't necessarily invest there. Look right next to it.
Mhm.
Find a neighborhood that has similar characteristics. And again, think like a renter. I really want to live here, but rent's maybe a little too high or something else is off. Where's a cool area that has similar characteristics just next door to it, right? So we found an area called Avondale, and it's right next to Logan Square. It had a lot of the same characteristics that Logan Square had, but it was more affordable. And the reason this is important is as an investor, certainly I want higher rents, but as a buyer, I don't want the higher price tag to get it either, right? Like there has to be that profit per door that we're looking for, and it was out of whack in Logan Square. But if I moved over to Avondale, I was able to find that, so I invested there, bought a 3 unit property, and that did really well as well.
That's a great piece of advice, yeah, because ideally everyone wants to be in the hot areas, right? But usually the hot areas are hot for a reason, and pricing usually matches that. But if you can find an area where it's right next to it, and like you said, has similar kind of stuff going on there, you can kind of capitalize on that. Because a lot of times what will happen is it'll move that way as well. The good area will move into that market right next to it. So that's great that you guys were able to figure that out. So then did you guys go into some bigger stuff after that? What was the next deal from there?
Yeah, after that, we bought an 8 unit building, and that 8 unit building was very strategic in our goals, at least. So I wanted to buy a commercial property for two reasons. One, I just wanted to scale up into commercial. I think for us, you talked about confidence and getting traction in the business. At that moment, I made a decision that I was going to do this. This was not just me building my personal portfolio. This was, we are real estate investors. We are going to partner with other people. We are going to scale a portfolio. We are going to grow. So an 8 unit building and getting into commercial was really important for me for that reason. The other reason it was really important is I hired a property management company. And that was critical just because I wanted to get experience managing the manager. Up until that point, I managed everything myself, and I'm a pretty good manager, but I didn't know what to expect managing a third party company, and if I was going to scale and do these bigger deals and working with other investors, I didn't want to be learning while, I was working with these other investors and making mistakes that honestly I probably could have figured out if I would have had a little bit more experience. So for me, it was a matter of just getting a little bit more experience of my own before moving there. I think literally I bought that property in like November, and the next month I ended up meeting the guy who was going to be my coach, and that helped me really shift and expand everything. Because in my head, I was just going to go from the 8 units, maybe a 12 unit, And, if I could bring on one investor or one partner, that would make me credible because I had an 8 unit that I ran by myself, right? So that's where my head was at. But in bringing in a coach or a mentor, that helped me, one, to build my own credibility because now I had this person in my corner, but then two, I could see what they were doing, what other people were doing, and really learn more about apartment syndication, which I had never even heard of. I just thought you either had all the money yourself or you partner with other people you knew and you bought, whatever properties you were going to get. I had no idea that you can pool money together and then work together as a team to go out and buy larger apartments. I had no clue that this was actually a thing.
Yeah, that's really interesting. Yeah, me too. The same, right? You see all these large apartment complexes everywhere. You don't realize that maybe there's people like just normal people like you and me putting a team together and buying them, right, with their partners or whatever. You always assume there's massive companies that are buying it, but in reality, there's plenty of people just like you and me that's doing this all the time. So when I had that realization, my mind was blown. And I thought it was really cool. I thought it was really cool and exciting that people like us could kind of do that. Going back a little bit, because you said a few interesting things there. You wanted to manage the manager, right? And I think that's a fine line, right, for a lot of people between micromanaging and then maybe not doing enough, right? Because you don't want to micromanage enough because you're going to annoy the manager, right? Every 2 minutes, you're like, hey, are you doing this? Are you doing that? Or I need you to do this way. I'm like, well, you might as well be managing it yourself. But at the same time, I'm sure you've had the experience. If you let the managers have too much of a free reign, not intentionally, but they're not going to maybe be on top of stuff quite the same. So how did you finding that fine line of managing the managers properly?
Well, I mean, to your point, I mean, that was really what I was trying to sign up for, is how do you do that? And I wouldn't have known without going through that process because I had only managed it myself. And I think one thing is to understand your expectations of what should happen or how to manage it may be unrealistic when it comes to working with a third party manager. So if you are very hands on, if you are, just be honest with yourself, if you're controlling and you want things done a certain way, and you have your own process, third party management may not be for you. And that's fine. There's nothing wrong with that. But if you're looking to scale and grow, you can't scale and grow without working with other people. You're going to have to hire people, whether it be a vendor, whether it be a virtual assistant, whether it be a maintenance guy. So you have to pick and choose how you scale, how you grow, and then how you give direction to your team. And I think going back to my corporate experience, one of the good things is I was overseeing 7 different agency partners. So I had 7 agency partners, one that just did our digital marketing, one that did our TV, radio, print, one that did our events, one that did our multicultural. So I had all of these different agencies that, I would work with. And, there was a lot of delegation that had to take place between that, right? We would sit down once a week and we go through the business plan and where are we at with this? Where are we at with that? Okay, did you book this? Okay, cool. And then we might have a couple emails throughout the week. We could obviously do some phone calls, but the expectation was they were running with what we talked about. So with the property management, I think your job as the owner or the investor is to lay out the business plan, lay out some clear goals, some clear objectives, make sure everyone's clear on the strategies to accomplish that, and then let them execute. But you have your check-ins, and your check-ins are the areas where you can see how progress is being made. And if you're not happy with the progress, then you dig deeper and you understand, hey, what's going on? I thought we were going to be 90% occupied. We're only at 86, or whatever the number is. And you sit and you talk and you understand, well, what's happening in the marketplace? What are you seeing? Okay, well, did you try this? Did you look at this? Do we need to increase the budget here? But then you can start to pivot and come up with some options, but you're still giving them some power. So you're not micromanaging, you're just understanding what's happening and giving direction. Now that takes some experience and knowledge yourself, right? Because if you don't know how to fix the challenges, then it's the blind leading the blind. Or worst case, you have a property manager who's just going to do whatever and tell you, hey, no, this is just how it is. And to your point, I think you still want to stay in control because it's your property, but you want to trust the team you build around you. And what I would say is anytime you're working with someone, whether it be a property manager or a contractor or any of your vendor partners, you want to understand their logic and the way they are coming up with their decisions. So in a case where they're trying to tell you this is how it is, they should be able to explain that to you, you know, and they shouldn't take offense or get upset, but they should be able to explain to you, hey, here's why we do it this way. And if you have some pushback or you have some questions, you should suggest it. And I think for me, especially coming from corporate America, where I was used to working in teams and working with large companies, a lot of times I had more knowledge on how things should be structured or managed just because I'm used to that kind of corporate structure. You know, even though they have the experience from, you know, property management, since they manage so many properties, they may not have it from an organizational or process standpoint. So sometimes we would sit down and I would just give suggestions. Well, hey, did you think about a checklist for this or think about that? And it was, okay, that's a good idea. And it also helps to have a conversation or at least a relationship with the senior level folks at that property management company, because you can call a senior exec and say, hey, I'm having this issue, you know, how can we work through this? It's not about going around someone's back. They're your day-to-day property manager, but it is about understanding the fit. And if I can't get what I need, then I probably need to find another resource. So, I mean, hiring a property management company, it takes work. You know, it takes some process to screen and get comfortable and to know what to look for. But if you're going to scale and do larger deals, or if you're someone who's doing this so you can have more free time with your family, you may not want to sign up for a second job. So figure out what you need in a property manager. That way you can manage the manager and really do what you need to be doing to drive either the business, but also your home life.
Yeah. I think too many people get caught up when it comes to property management in that percentage, whatever it is, 8, 10, whatever percentage fee it is, right? They get caught up in that. Well, I'm paying this person 8% of my money. Yeah, but what people don't realize is what you get for that money, right? Like you said, you get that freedom, you get experience, you get another set of eyes, another set of opinions of how the property should be run or what things should be done. And I think that's invaluable. And I think so many people get caught up because you go on Bigger Pockets or whatever. People, first thing when you talk about property managers, almost always is how much do you pay them? Well, to me, that's irrelevant, right? I'd rather pay someone 12% and they did an amazing job than pay someone 6% and they're not doing their job very well, you know, because they'll earn that fee. If they're a good property management, and you also touched on something very important, is the vetting of the property manager. You got to find the right property management for what you want and what type of property you have. That's obviously very, very important. But once you have that as well, the fee is irrelevant to some extent. Okay, now they're trying to charge you 30%. You might want to think again. But that fee that they get, it's kind of almost like the interest rate that people are always worried about, the interest rate. Well, what kind of terms are you getting for that interest rate on your mortgage, right? It's that percentage can be, you know, high or low, but if the terms are great, you'll pay a higher percentage. So I think something that I always try and tell people is that what I found is that percentage fee is irrelevant, right? It's something that you're going to calculate anyway when you're running your numbers, and you should always calculate a management fee in there. But more importantly, what do you get for that percentage fee, and what are they going to do, right? And you touched on a lot of stuff that they do and how to work on it. So I think that's really important. So, but anyway, sorry to just get into that a little bit, because I hear people say that all the time, and I'm like, that's not so important.
But I think you're spot on, Barry, because I mean, to your point, and what you may need to do as well is just get clarity on what you're solving for.
Mm-hmm.
Because I mean, in 2020 and going forward, there's a lot of technology that can help. So if you really want to manage it yourself, there's technology that may be able to help you with other aspects, whether it be the bookkeeping or the accounting or the rent collection. There's Cozy you can use.
Mm-hmm.
So if you really do want to be hands-on, there's nothing wrong with that if that's what you want. But if you're trying to grow and scale, you're going to need to rely on other people. And in that case, you know, like you said, it's not so much what that percentage is, it's what's their value. You know, it's a value equation. Because if to your point, if you pay someone 12%, but you knew that they could deliver a 20% return on your overall investment, versus you pay someone 8% and they're only going to deliver a 12% return on your overall investment, would you be willing to pay the extra 4%? I mean, of course, your goal is to make as much money as you can. So it's not to get derailed into how much you pay them. It's, can they deliver the value I'm looking for? And if you can get a really good property manager, they're going to add that value to you because they're going to be able to screen tenants better. They're going to be able to, get units rented faster. They're going to be able to manage your expenses. They're going to be able to make decisions without having to call you all the time. So they're going to give you more of your own free time. So they're going to be worth it because they're going to know how to run their business. If you get someone who maybe doesn't have that capability, you may have to be more involved. You may have to, help with the marketing plan to get units rented. You may have to do more concessions because maybe they can't get it rented or lower the rents. So you just have to factor all of those things into it and not look at that flat fee amount.
Yeah, that's brilliant. You said it 10 times better than I tried, but yeah, that's so true. So the 8 unit, it's your first multifamily, right? For anyone who's bought commercial, it can be a little bit more challenging than buy a single family or a duplex or whatever, that four units and under. Did you find any barrier to entry on that 8 units? What troubles did you have with that first one?
Yeah, I mean, there are a couple things that are different from especially when you're coming from, buying 2 to 4 units of residential properties to commercial. First and foremost is the lending side of things. Okay. So, I was told in all the books and stuff I've read, they say, oh, you go commercial, you get non-recourse. I'm like, oh, that's great. We'll do this deal, get this non-recourse loan. It's going to be easy peasy, right? Wrong. So technically it's true, but that's only if you go above $1 million and you get a non-recourse loan. This property was under $1 million. So most of the lenders who would do this were smaller or local banks, regional banks, those kind of players. So I still had to do a recourse loan. So it's a little bit different. I wasn't expecting that, but it's fine. The other thing that was different are the rates and the terms. So on a 2 to 4 unit, you're getting 30-year terms, amortization schedules, fairly low interest rates. When you go commercial, the standard commercial loan is like a 5-year loan, 20-year amortization or 25-year amortization schedule. But it's 5 years and you have to either refinance or, or the balloon payment comes due. And it's amortized over a shorter time frame, only 20 or 25 years. So that was the other thing that was pretty different. We actually found a lender who would do a 30-year amortization, but that took a whole lot of conversations to get there. Some of these loans have interest-only periods. When we did that loan, we did not have interest-only, but just understand that the loan type is very different than what you might get with residential, where residential is pretty straightforward. It's like you get a 30-year loan, and to your point, I mean, the interest rate is the only thing that matters because that's really the only thing that varies. Versus commercial, you've got the length of the term. Is it a 3-year, 5-year, 7, 10, 12? We're looking at a HUD loan that's 35 years. What's the amortization schedule? So just because it's a 5-year loan, it's typically amortized at 20, 25, or 30 years. Sometimes people do it at 15 years. So you got the terms that you've got to figure out. Then there's, of course, is the interest rate. And then the thing that people forget is the prepayment penalty. Mm-hmm. So what happens if you decide to sell this thing early? What's the penalty you have to pay? And does that go down each year? Is there something that's called yield maintenance, which is kind of that difference that you'll have to pay based on what the market is doing right now? So there's all these different factors of the loan. So the loan was one big difference going to commercial. The other thing was there's different expenses that you have to deal with. And in Chicago in particular, the trash is included in your property taxes for residential properties. However, if you have a commercial property, you have to pay for trash and you have to hire a whole separate vendor to do it yourself. So I knew that going into it, so we factored that in, but that wasn't something we were used to doing on our previous properties. So it's just a little bit more time as well is what it took to do the deal. Ironically, it was actually easier to get the loan. The process, they basically asked for some information. Once they got it, they're like, all right, cool. When I would do residential loans, they would go through my bank statements and like anything that was north of $1,000, where did this come from? It's like, dude, like, what? That was a bonus. This was this. Why'd your mom give you this money? It's like, I gotta justify why my mom gave me $1,500. Like, guys, you see what I make. You see this other stuff. Like, what are you questioning here? So, I mean, they rip you right on residential loans. They want to know everything. On a commercial, they just looked at it like, all right, how much you make? Give me your tax returns. All right, give me the income statement. All right, you good. And so, I mean, it was a pretty straightforward loan process, even with the recourse loan. So I did like that a lot better than the residential stuff we were doing.
I think the great thing about multifamilies as well is they look at you to some extent, your financials and your experience and stuff like that, but also the property is what they kind of look most at, right? So if the property is a great cash flowing property and, you know, they meet the debt coverage ratio that they need, you know, the amount of income versus the amount of debt that you have on the property or that you have to pay for the property, you know, these things are what they look at. And if those things are very strong, it's much easier for you to get the loan done. And, you know, they, like, as you mentioned, they don't look at you as much. It's not as important for them as the borrower.
Yeah, that's it. Spot on. I mean, they're looking at that property first and foremost, especially as you go into non-recourse, but they're looking at the property. They want to know that you're capable of doing what you want to do. And then the other thing too on that first property is that first commercial property, they actually were pushing for me to work with the third party property management company, which I had planned on doing anyway, but they made that kind of a priority or kind of a mandate for their loan as well. So just know that if you're one of those people who says, hey, I'm just going to do it by myself, if you're looking to go commercial, your lender may force you to work with a third party property management company. So just make sure you understand that and you anticipate it.
And for the people who might not understand why would they make you go with the third party manager?
It goes back to what you said. I mean, they're looking at the building and it's a business. I think the biggest difference from residential to commercial is you are buying real estate, but in commercial, you're really buying a business. And they want to make sure that the people who are doing the day-to-day operations of that business are qualified to do it. You know, so they look at you as the investor owner, but they want to know the property management company. They want to make sure that it's someone reputable, not your cousin Sammy. You know, just they want a real reputable company that's doing this that can execute based on what it's currently doing and then based on the business plan that you're proposing. So that's it. Because if you fail, they want to be able to take that property back over and get it to a new owner that they feel can do it. But if you run it into the ground because you just decided to be super cheap and not fix anything or whatever, then that asset is going to deteriorate in value. So they want to make sure that, you're actually going to do what you say you're going to do, take care of the property. And usually anybody who works with a property management company, you're going to have to invest into the property to some extent.
Yeah, very true. So then from there, did you go into larger stuff from there? Did you go into a syndication? Was that your next deal?
Yeah, it was. So people always get a kick out of this, but I went from an 8-unit building to 192 units as my next deal.
Okay. You just scaled a little bit then. You just think, yeah.
Just
why didn't
slightly.
You go bigger? No, I'm kidding.
Yeah, exactly.
That's cool though. That's really cool. I love stories like that because it just, for one, it shows you that you can, right? Shows you how quickly you can scale if you make that decision and you apply yourself, you can. But maybe talk about how did you have the confidence to do that? Because I think for a lot of people, myself included, is that limiting belief or that thought that I can't do this, right? It's 192 units. How can I take down 192 units?
Yeah. So I think first and foremost, I want to break this down because to your point, I mean, when you see that and hear that, I mean, don't turn this video off right now, right? Because some people are like, man, I can't do that. Click just the next video. Yeah. So what you have to do is break it down. Okay. And there's an adage about how do you eat an elephant? It's one bite at a time, right? And the reality is I didn't do this by myself. And in fact, the way I even came to be involved is I had built relationships, and I tell everyone, focus on networking. And a partner ended up having this deal. And as we were talking previously, we had expressed interest in working together. He found this deal. He had another partner he was working with. I said, hey, listen, I'm still interested in being involved if there's an opportunity. So they brought me into the deal, and we came on as general partners on this deal to just help take down this elephant, because it was their first big deal too. So we were all trying to figure out how to do this large deal. And the big thing that I would tell you and everyone watching this right now is you have to shift and pivot your mindset and be open-minded about how can you do larger deals or a deal or whatever frame, whatever you want to put in there. And for me, it wasn't I want to do a large deal. It was I wanted to help the investors I've been speaking to, and I wanted to build my credibility. I wanted to build my confidence, and grow. And I needed to do deals to do that. And I've been looking for my own deals for over a year and a half at that point, and we couldn't find a deal that penciled. So that's when I said, okay, well, maybe I can help other people or someone else at least, and work with the people that I've already gotten to know really well, as opposed to only looking at my own deals in my backyard that I control 100%. A little slice of pie is better than no pie. And I've been eating no pie for quite some time. So it was time to get a little bit of pie. So that's the biggest thing, right? Is just opening yourself up to saying, how can I get involved in a deal like this? How can I make that transition commercial? How can I grow my portfolio so I can take care of my family and have the diversification and the peace of mind that I long for? So that was really my driving point to say, how do you do this? For me, as I started talking to more and more people, the opportunities just started to present themselves. And like I said, we built a great relationship. So I didn't walk around offering this up to everybody, but for this group in particular, I got to know them pretty well. My wife knows them and knew them back then, and it was just something where it's like, look, something makes sense. Let's talk, and it just worked out.
For people who listen to this show, I often talk about the mindset, and I love the mindset component of stuff because I think it's so important, right? The numbers and the deal and stuff like that, right? Yes, it's important, but unless you have that mindset component first and the ability to figure out up here what it takes to make it happen, it doesn't matter, right? You can have the best deal in the world, but if your mindset isn't in the right place to move forward and take down that deal, it doesn't matter. And I love how you said that you've got to rephrase the question and rephrase what you say to yourself. How can I, right? Instead of saying, shit, how do I make this happen? I can't take down 192. Well, of course, if you tell yourself that, of course, you're never ever going to do that. But if you say, how can I, and open that mind, and you're asking yourself, how can I? Well, other things are going to appear. You said like maybe partners and people and deals and stuff, they come up because you're open to it. How can I make this work? And that doesn't apply to this. That can apply to whatever you want to do, right? That's a great thing about mindset. It just doesn't apply to real estate. But I love how you say that. You've framed that question differently, and it just makes such a big difference because you're so much then more open to options and things that come your way rather than thinking, no, this isn't going to happen. So that's really cool. That's really cool.
And to your point, I mean, it really starts with who you surround yourself with and what you're feeding yourself. Because if I go back to where I was with the 8-unit building, I wasn't really thinking about partnerships. I wasn't thinking about any of this kind of stuff. I just needed somebody who has some money to help us scale, right? I was using all of my own money up to that point on every single deal we were buying. And the roadblock I saw was I was just running out of my own money. So my mindset was, well, if I can go get other people to help invest with me, then we can do more deals. And I think that's where a lot of investors and a lot of people watching this may be is, hey, okay, I'm doing deals, but to grow, I'm running out of capital. How can I partner with people to do deals? And that's a very natural place to start. My pivot, and this is really important, my pivot, it was a half pivot when I met my coach and mentor because I saw the deals they were doing.
Mm-hmm.
And that opened me up to the possibilities of doing larger deals. And then I started to say, man, he's doing these great deals. That's crazy. It's amazing. And then I started to ask, man, well, how is he doing it? Then how can I do it? And then from there, my goal and everything shifted from me to how can I help other people? And as you start talking to investors, think about business. We've talked about business before in this whole episode, right? So if you are in business, you don't walk around your business saying, all right, how do I make money on this? How do I do this? You can, but you very quickly will need to pivot to what are people looking for? What do people want in a product or service that we can offer?
Mm.
Yes, we want to monetize it, but I need to offer something people want. You need to learn what they're looking for. And the moment you pivot to understanding what people want, where their needs are being unmet, how can you add value to other people? How can you serve your audience? How do you do these things? Now you've positioned yourself to actually have a business, because if you actually listen to what they need and where their needs are unmet and what they're looking for and why they don't like the options that are in front of them, now you can present an option that works great. And I tell you, I had a conversation with one of my investors early on, and it was like the light bulb just went off, right? And he was talking to me about his taxes, and he had money to invest, but he was spending so much money in taxes, and that's the reason he was interested in real estate. And I realized it wasn't about me. It wasn't about me or the deals I was trying to do or anything about me. This guy was looking for help, with his situation, and the deals we were doing could help him. Or people who were looking to diversify their income or looking to get into real estate, but man, I'm scared to do this deal by myself. But I would invest with the guys who know what they're doing, or I'm happy to come in and learn. So when you understand how you help other people, now you don't put extra pressure on yourself to raise money. It's like, oh man, can I raise this money? Can I do this? No, it's who do you serve? If you can help enough people, then you can grow and you can start to do well with investors.
I was smiling the whole time you were saying that, because it's brilliant. It's absolutely brilliant. You're not asking people for money. You're offering the chance to help them with whatever situation, with whatever they're looking to achieve, right? You're helping them with their financial goals. So it's actually the other way around, right? It's not like, hey, give me money, give me money. No, you're actually helping those people. And like you said, when you come from a position of serving and you want to serve these people and help them, add value to them, that completely changes that conversation and that mindset. And I think something else that you said that was really good early on is that, after surrounding yourself with a coach and other people that were doing this, you saw that I can do this. Wow, this is how he's doing it. It makes sense to me. I can see it. I can feel it. Kind of goes to the back to when they talk about when people were trying to run a 6-minute mile, right? Nobody could run a 6-minute mile. Nobody could run a 6-minute mile. Then one guy ran 6-minute mile, and then the following week, 3 or 4 other people ran that 6-minute mile, because that one person did it, and everyone could see that you could do it. And it's the same thing with, that's why it's important to surround yourself with people that are doing what you want to be doing, right? Not necessarily where you've been or what you kind of stuck on now, where you want to be. And if you surround yourself with that, you just see them doing it, and it's just going to lift you up. So I thought those two points were really cool. So I appreciate you sharing that. So to this, where we are sitting today, how many syndications have you done since then? How many units are you guys at?
Yeah, we're close to just over 900 units in our portfolio as general partners on these deals. We've got a couple of deals we're working on, so hopefully that number will increase very quickly here. So excited about that. But yeah, we're continuing to grow. I think that's like over 6 deals or something like that.
Okay. What is it? Is it business? Is it a value add business plan that you guys have for these properties? Is that what you guys work on?
Yeah, primarily value adds. We like to find properties where interior units can be renovated. Maybe there's something we can do with the expenses, but just a way to add value that we can increase the value of the property, increase the cash flow, and return that profit to our investors.
Cool. And then, what, if you don't mind me asking, what is your goal for the future? What do you guys have? A number of units? You have I'm sure you have goals, right? Someone as successful as yourself. What is the future hold for you? You think?
Yeah, so I mean, not really number of units. I'm way less concerned with that. I am interested in being able to help as many people as we can. So, I'd love to hit 1,000 investors. So that's really our goal is, or one of our near-term goals is to get to the point where we've worked with over 1,000 investors. Because I see, again, go back to the product or service thing, right? Like the multifamily, that's the brick and mortar, but that's not what's important. What's important is helping people diversify their income, get passive income, get some of the tax benefits and get some more time with their family and their loved ones to do whatever it is that they enjoy doing. So, I'd love to hit 1,000 people served, if you will, almost kind of like that McDonald's thing, right? Where they've got like the billion people served kind of thing. So we'd love to get to that, and that's really the way we're looking at it, is based on our investor relations and our investor conversations. But for us, we want to grow a business. I don't want it to be a crazy big business type situation, but on the same note, we are looking to grow. We want to have an actual business that is profitable, that helps people, and it's something that we can run and operate over the next 2, 3, 4 decades.
Yeah. You guys are in Cincinnati, right? You guys are with the syndication. You guys are primarily in Cincinnati.
Yeah, looking more this area. So Cincinnati, we have deals in this kind of region, and I would say within a 2-hour radius is where we're primarily focused. So Indianapolis, Columbus, Lexington, Kentucky, but then we also partner with other operators still in select markets. So if we come across a great deal that we love and we want to be involved with as general partners, but it's in, say Florida or Georgia or something like that, then we'll look to get involved and bring those opportunities as well.
Cool. Yeah, cool story, man. I really like what you've done and where you're going as well. And I like the way you look at stuff as well. Like you said, the investors is more important than the number of units. Because if you find the investors, for the most part, yes, you've got to find the deals, but the money is one of the, not the hardest thing, but if you have that and you have the investors in place and you're serving them, a lot of the other stuff is going to take care of itself. I think that's really.
Yeah. And Barry, can I give a little context on that too?
Absolutely, of course.
So it may sound like a little nuanced, maybe it's not important, or maybe it sounds like like a little marketing thing I'm saying, is that, we care about our people and not the buildings. But I want to give context to why that's important, how that actually fuels my thinking on this. Okay. So a lot of people focus on units, and that's their focus, right? And they're just going to buy multifamily apartments. When I say focusing on investors, it may not be multifamily in the future. We may invest in businesses. We may invest in, something else completely different, e-commerce. It could be anything. So the reason I say that is to say, we want to focus. I love multifamily, and that will be our foundation. We will absolutely focus on that. That's our bread and butter. But we want to be open to other asset classes, hospitality, or, like I said, businesses. We want to be smart and make sure we can provide a diversified portfolio of investment options, of alternative investments, right? So that gives me more flexibility in the way we think and approach it, because we are focusing on how do we help people and what are they looking for, so we can react to their needs, versus simply saying, we're buying a building, who wants to come with us, right? So it's which one's on first, who's leading the conversation. I think we can react based on what we're hearing from our investors and what kind of assets they're looking for, because someday multifamily may fall out of favor, and then at that point to try to pivot, it may be too late. So for us, we just want to keep our options open. We are steadfast focused on multifamily, but we also want to continue to explore and understand other investment vehicles and options that are out there.
That's really smart, especially with everything going on right now. Right? You never know what's going to happen in the world next, right? 2020 has been a crazy rise, so you never know what's going to happen next. So I think that's smart. As I told you before, the show is called Wrestling with Real Estate. So I always like to ask some wrestling themed real estate questions to kind of bring it back to the wrestling. First question is, what would your wrestling name be? If you had to pick a wrestling name for yourself, what would it be?
Well, this because I've told you about this before, but I was a big time wrestling fan and actually thought I was going to develop into the wrestling industry. My dream job would have been to work for WWE at some point. So I actually used to do, I don't even know what you call it, fantasy wrestling or role play wrestling or something. Okay. So I would write characters, and I actually was the commissioner. So I would, I'd make matches, and I'd have to role play. I'd have to write out who won in the matches and all this stuff. It was really some geeky stuff. But anyway, my character's name was John Blaze. And so John Blaze would probably be the first name. And he had a tag team partner at one point. His name was Justin Case. I always thought that was a cool name. Justin Case. So he always had little weapons and things like that he'd pull out, just in case.
Why the Blaze?
People just started calling me John Blaze, I think it was off of Method Man had a song or something like that. And people just would always call me John Blaze, and, it just went well with the fire. And I don't know.
Yeah, I like it. I like it. I was just
Yeah.
thinking to see where it came from.
Yeah.
So every wrestler has a signature or a special move. What would your special move be in real estate?
Oh man. So, it had to be something marketing related, right? So, yeah, man, it's good. I've gotten real big on it. I've gotten big into marketing automation.
Okay.
So I don't have a name for it, but it has to be something in marketing automation, just in understanding the funnel, right? It's like you get someone who's interested in learning more about you, and then how do you actually engage with that individual through the next few steps, but automating it so it's not like I have to call this person, and now I'm calling like 10 different people each time. So how do you figure out a way to automate it, but still give great value to them? So marketing automation would probably be my signature.
So some kind of funnel bomb or something like that.
Yeah, I like that, man. Look at you. You got it. The funnel bomb. I might use that. The funnel bomb.
That's awesome. What's been the biggest body slam you've taken in your investing career, you think?
Man, I've taken a few, and it's one of those things too, where starting off, especially, I had a lot of great success, right? I mentioned the first couple of deals were like just slam dunks, easy deals, made good money on them. And when I was at the point where I wanted to get into larger multifamily, I knew, the challenge I was trying to solve. And again, I think everyone should always focus on what problem are you trying to solve and then figure out the potential options on the table. The challenge I was trying to solve was I had run out of money, my own money, to continue to buy multifamily. So a couple of the solutions I was looking at were syndicate, work with other investors or raise money. The other was to flip properties to generate more income that I could put back into properties. Well, I tried to do both, and I tried to do both at the same time. And my flippings were an absolute disaster. Now, I was savvy enough to know that I wasn't a flipper and I wasn't going to try to do that. So I ended up partnering up with the guy who was a developer and a flipper. And this is what he did full time. And, he had this trolley. He would show people by it. He had 10 projects going at one time. So I felt like he knew what he was doing. And, he had that kind of credibility and he was putting his work out there. But, we got into the project and it fell apart, a few months in. And, I ended up having to take over the project completely and finish it. And I had no experience flipping or, working with contractors like this. And, we lost money. It was a tough it was a tough project to do and to lose money on. And, I think anytime we get body slammed in life, there's a lesson to be learned, and it doesn't mean you're out for the count. It just means that there's a lesson, learn the lesson, and move on. And if you don't learn the lesson, you'll probably get body slammed again until you learn the lesson. So you just have to keep stopping and learn the lesson. And for me, it just comes down to this, trust your gut, and not blindly, but I'm saying if you've put in the time doing research, trust that. Even if all you've ever done is read a book or listen to a podcast or whatever, if that's the only experience you have and you come across someone who's doing it, trust that experience, because there's a reason that the books you've read, the podcasts you've listened to, and everyone else, there's a reason they said these things. And if you're going to go against that, then you have to understand what that is. And for me, I trusted the person who was a quote unquote expert, and I had questions about what his business plan was, but we didn't get the answers we were looking for. And I think for me, you are ultimately responsible for your own decisions. So if you're not getting a great feeling or a great vibe, you know, back away from it at that moment. Don't just go through it just because you believe that person knows what they're doing. If you don't believe in it and understand it yourself, and if you're not comfortable, then don't move forward.
Yeah, that's great, guys, because it's surprising how strong your instincts actually are, right? If you have strong feelings about something and you don't know why, you should probably act on those things, because there's a reason we're able to sense fear. I think it's part of our nature. You're able to sense fear because we used to have to look out for lions or whatever, and you kind of have that instinctual feeling in you. So I think that's great. Was there a moment that you were standing on the top rope, getting ready to jump, but you were too scared? What was it, and how did you overcome it?
I would say the first deal we did after, I think it was that 192 unit actually. And part of it was, there's this theory of failing forward, that I've more recently gotten familiar with. But I think part of it was when you have a deal that doesn't work out, it's tough to just trust your instinct on the next deal, right? Because you're sitting there, you're double questioning everything, and you're going through all of that. So even though it was completely different, but it was a partnership, it was a lot of other questions there. So it came down to I never raised a dollar up to that point. I don't think for anything, to be honest with you. But that wasn't my skill. I wasn't a salesman. I was a marketing guy, but I wasn't a salesman. So I wasn't the guy who just picked up the phone call and said, hey, I need this, buy this. I wasn't that guy. So when we went in on that deal, I had an obligation of what I was supposed to deliver on my side, or at least what I felt I could do in the deal. And, I had a decision to make, like, are you going to do it? Are you going to be involved in this deal or not? And there was some trepidation on whether or not I could hold up my end because I had never done it. And the last deal I technically didn't work out too well. So I was a little concerned on how I was going to go forward. Now, again, all of the multifamily deals went great, but, there was just that trepidation just because it was unknown, right? It's just, I never tried it. So I didn't know what to expect, but I overcame it because I remembered the preparation that I had. I had been working towards this. I had done everything in regards to talking to investors, preparing them for the kind of opportunities that would be coming their way. I had a mentor in my corner that I spoke to and said, hey, look, how would you word this? I practice. My wife actually helped me go over the material and highlight the right things and practice it and stop fumbling over words and just making sure that we were clearly communicating the opportunity. And that was it. The last piece is removing the pressure off of myself, because it wasn't about whether or not I succeeded or not. It was about presenting an opportunity. And if I didn't hit my goal, all that really meant was I didn't present the opportunity to the right people at the right time, right? Or maybe I missed the key pieces of the opportunity. But I nailed that part, so that wasn't the issue. It was just simply going to be, I need to expand my network so I can share this opportunity to more people who are probably a better fit than the folks I'm presenting it to right now. So you just have to learn and grow. And I think for me, when I got comfortable with the fact that, failure is not really an option. You're either going to do it and have success, or you're going to learn some stuff that's going to help you be better. And you truly embrace that. I mean, you just have to truly embrace that and not put a label on it. If you fail and you label it as a failure, you call yourself a failure, you feel like I can't do this, or I'm not good at this, or I'm not comfortable at that, then you just cut your legs off and you won't even want to try. But if you just let the chips fall where they fall and say, you know what, I probably could have worked a little harder making phone calls to people in my network, or I could have, worked a little harder to do this or whatever. And just learn from it and implement it. But, focusing on that versus, the result, I think really helped me go ahead and make that move.
And that's gold. That really is. You never fail unless you let yourself tell you that you fail, right? Yes, you can not succeed in your goals and you can not reach your targets, whatever, and you can ask yourself questions. Why was that? What can I do differently? What could I do better? But like you just said there, if you tell yourself that you failed and you're a failure, well, where are you putting yourself there? You're putting yourself as a failure. And are you going to move forward from that? Are you going to do more deals? Are you going to, be wanting to reach your goals and reach your targets? Probably not, right? You're putting yourself in such a negative category. So I think that's you either earn or you learn, right? You either earn money or you learn from it. And I think that's brilliant. That's just, it's so basic, but so true, right? It's just for anyone can apply that to what they do. So cool. Well, John, this has been a fantastic conversation. Like we talked about so much cool stuff in today's interview. I've really, really enjoyed it. It's been awesome. There's been some real gold in this interview for me. Like so many great points you've brought up today. So I appreciate that, just listening how you started out and how you picked the market into then going into an 8 units and kind of the stuff you learned on that 8 units from managing the manager and kind of then jumping into 192 units, which is really cool to hear, and kind of the mindset stuff that you had to go through then and just growing from there to 900 units is just fantastic. So I appreciate you sharing all that with us today. I've really enjoyed it. Before we go, though, where can people get a hold of you and learn more about what you're doing?
Yeah, I mean, I think the biggest thing is if you're interested in scaling your portfolio, getting into multifamily, or even investing passively, I do have a sample deal available on my website. So you can go to casmoncapital.com/sample deal. You'll see kind of how we put deals together. If you want to borrow some ideas from there, feel free to do that. Or if you're interested in working together, I'd be happy to talk to you more about that. But go to casmoncapital.com/sample deal. You can download that deal package and use that to help you grow as an investor. And then if you just want to reach out, you can reach me at john@casmoncapital.com.
Cool. Any social media links?
Yeah, I mean, you can pretty much find me anywhere. LinkedIn, John Casmon. I don't know what the LinkedIn link is, but just search John Casmon, you'll see me. And then at @JCasmon on Twitter and Instagram.
Cool. I'll put all those links in the description.
Yeah.
Cool. Well, thank you so much, John. I genuinely mean that. I love this interview. It was so much fun. Thank you for making time. I appreciate it.
Absolutely, Barry. Thank you for having me on the show.
Cool.